In the world of investing, exchange-traded funds (ETFs) offer a diverse range of opportunities for both growth and income-focused investors. Among the numerous ETFs available today, YieldMax ETFs have gained attention for their unique structure and goal, generating high income through covered call strategies. But what exactly is a YieldMax ETF, and why would an investor choose to hold one? In this video, we'll break down the mechanics, the benefits, as well as the risks of YieldMax ETFs while exploring their place in a broader investment strategy. So what exactly are YieldMax ETFs? YieldMax ETFs are a family of exchange-traded funds designed to provide high monthly income by employing a covered call strategy on individual stocks or sectors. Now, unlike traditional income-focused ETFs that rely on dividends from dividend-paying stocks, YieldMax ETFs generate income by selling call options on underlying assets. Now, this options-based approach allows investors to collect option premiums, which boosts the dividend yield even on stocks that may not traditionally offer high dividends, such as Microsoft, Apple, and Tesla. Now, if we take a look at their ETFs list, we see they have a ton of ETFs, especially those on individual ticker names such as Tesla. We have Apple, Nvidia, Amazon, Meta, Google, and so on. So there are a ton of ETFs. Now, what we want to keep our attention on is this distribution rate. And as we can see, it has a very high distribution rate for every single one of these ETFs. Now, this is going to scare a lot of people as well as attract a lot of attention because this is something that is unheard of in the stock market. But we also have to understand that these funds are employing a covered call strategy, so it involves owning shares or a long call option on an ETF or stock, and then selling that call option on the same security. The goal is to collect premium income from selling the call options, which provides investors with additional cash flow. Now, if the stock remains below the option strike price, the call option expires worthless, and the investor keeps both the stock and the premium. However, if the stock rises above the strike price, the investor may be forced to sell the stock at a predetermined price, limiting potential gains. So we do have to keep in mind that these funds do not directly invest in the underlying holdings. The strategy that YieldMax is employing is a synthetic covered call strategy, also known as a poor man's covered call. So instead of owning shares, they own a long-dated call option as their long position, and then they sell short-dated call options to generate that monthly or even weekly revenue. And because of this, we can see some crazy high distribution rates. And that is because this is an actively managed fund. Now, because it's an actively managed fund, we also have to realize that we're going to have around a 1% expense ratio on most of these funds. Now, because there are high distribution rates, we are going to experience some NAV erosion. If we take a look at some of their ETFs, such as TSLY, it is down almost 80% all time in the stock price alone. Now, if you see something like this, personally, I would not invest into something like this as it would be a depreciating asset. Even though you're getting these sweet dividends, TSLY is a very popular one, very high cash amounts. So for example, our last payment was around 46 cents per share on a stock that's only $8.24. That is a crazy high dividend yield. However, some of these other ETFs, such as PLT, are actually up positive on the all-time chart. So if you had gotten in at inception, you would have a seriously high return, not only on the stock appreciation, but because you're also getting those high dividend rates. PLT is around a 41% dividend yield. And another popular one, probably the most popular YieldMax ETF, is MSTY. And as we can see, it is a very volatile ETF, hitting around $43 per share, dropping down to $19 per share, and then bouncing back up and down again. But we're really after the dividends here, 163% dividend yield. If the stock stays flat and you hold this for a whole year, you're basically doubling your money based on the dividend amount alone. And if we take a look at the dividend history, we can see it's been paying over $1 per share every single month for the past year. Now, of course, these funds are all very new, so they are very risky, but a lot of people are willing to take that risk with some extra cash they have and throwing it into these funds. The main reason is to generate high monthly income. The primary appeal of YieldMax ETFs is their ability to provide substantial monthly income. Traditional dividend-focused ETFs, such as SCHD, which pays a dividend yield of 3.72%, a very solid, respectable yield for a dividend ETF, and other traditional dividend-focused ETFs pay quarterly dividends. that are in the range of 2 to 5% annually. Now, in contrast, these YieldMax ETFs have double-digit annualized returns, in some cases triple digits. Now, this makes it very attractive to a lot of people because it seems like it's a get-rich-quick kind of thing. Now, what makes them so attractive is for income-focused investors or even retirees and those seeking passive cash flow. A lot of people do not care that these stocks go down in value as long as they get all their money back through the distribution rate, and then they can just let that ETF ride with the house money. Now, this is particularly good because you're getting enhanced yield on growth stocks such as Tesla, Apple, Nvidia, Amazon. Many growth stocks, such as those in the technology sector, do not pay dividends or have very low yields. So this enables investors to earn massive income from stocks that typically do not generate regular cash payouts by leveraging their price movements through covered calls. And part of the reason these stocks are so volatile is because the underlying stocks are very volatile themselves. The higher volatility these underlying stocks have, you're going to see a higher distribution rate. So Tesla is a very volatile stock, so we're seeing a higher distribution rate of 72%. Something a little safer like Apple that doesn't move as much, we're only going to see a 30% distribution rate. Very high distribution rate, but not as much as something like TSLY. Now, one thing we want to keep in mind is that if the underlying stock skyrockets, then ETF from YieldMax is not going to experience those gains because we're selling those covered calls. So for example, MST has a 5-year growth of 2,500%. However, MSTY is basically flat at negative 0.25%. So the ideal situation is a steady increase in the stock price compared to something that rapidly jumps up. Or even if the stock price just stays flat, we're going to receive those high distribution rates from YieldMax. Now, personally, I'm investing in a small amount of YieldMax ETFs. MSTY is one of them, but I particularly like these fund of fund ETFs. One of them is going to be YieldMax with a distribution rate of 50%. Now, if we take a look at the holdings in YieldMax, we're going to see other funds of YieldMax inside it. So we have the Apple YieldMax ETF, we have Carvana, we even have a gold ETF, Disney, Netflix. So that's the main reason why I'm holding YieldMax. It's because it's diversified. We're not going to expose ourselves to massive risk from those single stock ETFs and instead pull our money into multiple. Another one I'm personally holding is YMAG. This has a distribution rate of 29%. And what it does is it invests in the Magnificent 7 YieldMax ETFs. So we have Apple, Microsoft, Tesla, Amazon, Google, Meta, Nvidia. So it's very heavily weighted on the tech sector. And one of the beauties of YMAX and YMAG are the weekly payout frequencies. So compared to all the other ETFs like MSTY, which pay out monthly, you're going to get payouts every single week. This is more frequency than people's 9-to-5 jobs where they're receiving paychecks every 2 weeks or even every single month. So something like this can help supplement your income and help pay off bills when you're waiting for your actual 9-to-5 job paycheck to cash in. Now, as much as YieldMax is popular, there are significant risks. As we saw with TSLY, the stock price can drop significantly. And in cases like that, you will either be break even or actually lose quite a bit of money. And especially in bear markets, it's very risky, but the best time to buy up risky investments are actually in bear markets or corrections. And we've experienced a 10% market correction on the S&P 500. We also have to understand that these assets are taxed as ordinary income. So if you are in a higher tax bracket, you're going to be paying a lot of taxes on these gains, on these distributions, unless you're holding it in a Roth IRA. So there you have it. YieldMax ETFs present a unique opportunity for investors that are seeking high monthly income through covered call strategies. They offer enhanced yield compared to individual stocks and accessibility for investors who do not want to trade options directly. But they come with their own limitations, such as capped upside potential and potential losses in down markets, and they are not very tax efficient. So by understanding both the risks and benefits, investors can determine whether YieldMax ETFs align with their financial goals and risk tolerance. When used strategically, these ETFs can be a valuable in addition to income-generating portfolio, which helps investors maximize cash flow while maintaining diversification. Now, personally, I would only invest a small amount of your portfolio into YieldMax ETFs. I'm a huge fan of safer ones such as JEP-B and JEP-Q, which pay out monthly dividends and have around a 7 to 10% annualized distribution rate. And of course, we can't forget our beloved SCHD, which pays out reliable, stable dividends every single quarter, as well as experiences stock appreciation.